Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? Hope all's going well with you. You're doing well and staying safe out there. Hey, here's an idea. Goldman Sachs had an idea. They say, the tech sector is doing really well. In fact, the tech sector has led the markets higher. If you've been following here recently, if not, I'll share a chart with you real quick. Here is the S&P 500 along with the tech sector in the purple line there. So the tech sector clearly outperforming the markets at the moment. And if you take it a step further and look at the NASDAQ's actually turned positive for the year as of now. And so naturally it's led by tech. And so everybody's like, oh my God, I want to be a part of tech here. And Goldman was like, whoa. Don't just go diving all into tech, which I agree with. Maybe break it down into categories. And so they asked the question, to their customers, and I'm asking the question to you. If you want to participate in tech, what are you investing for? How long are you investing for? See, every time a new customer joins us here at Jazz Wealth, we ask them, how long until you need this money? That helps us kind of decide where can you go? How aggressive can you be? If you've got a year left, you probably shouldn't be chasing some of these tech stocks. If you've got 10 years to go or so on, maybe that's the case as well, that you can be more aggressive. So what we did is we just kind of broke it down into categories and said, number one, let's pretend somebody doesn't necessarily know what stock to pick for what length of time. And then number two, let's say they don't know how this whole virus thing's going to play out. So maybe some people think, okay, maybe things will be fine in the long run. I'm not willing to invest in the short term. What stock should I pick? Or maybe people think there's going to be shutdowns for longer than expected. What stock should I pick? Because I still have to invest. So we got 4 different categories here. We're going to go through this and share some geeky stuff with you as well. Are you ready? The first is portfolio number 1. These are not recommendations in any way. I'm actually using Goldman Sachs Target and everything so that maybe they take the blame if somebody gets in trouble here, not me. Here's what we have. If you think that the shutdowns or the market, the economy in general is going to be held back for quite a while, then these may be some considerations for you. Spotify, Wayfair, Peloton, Grubhub, Netflix, and Amazon. These are companies that are largely expected to do well despite what happens in the economy. You're still going to shop on Amazon. I don't know that I agree with Wayfair. Spotify, you're listening to music, likely not going to cancel your cheap subscription there. And what we also put was Goldman Sachs' Target on there as well. So you can kind of see what it is that they're shooting for. If the stocks happen to hit those targets, we also shared the total return that you would expect to make per individual stock. Now I'm big on volatility, so I took it a step further and said, let's see the biggest drawdown that it's had since this virus started, meaning from February 19th to February 23rd. Let's just see what happens there. And so some of these are really nasty, right? You're going to see some nasty ones in a moment as well. So this would be the sample of like a portfolio you would put together if you're like, I don't know, I'm indifferent. If we close down longer, that's fine. If we don't, that's fine as well. I just want a good little couple pick of stocks that I can look at. What I did is I said, let's pretend you built a portfolio out of these. So we said, what is the total return, assuming that this portfolio hits all of Goldman Sachs' targets and you sell at that point, right? So we took the current target, we took the target return, said equal weighted portfolio, you stand the chance to make 13.66%. Now you're going to have to deal with some volatility. In fact, the max drawdown over the last 12 months happens to be about 35%. So basically correlated there with the market. So as you can kind of see there, it's going to be a bit of a wild ride. But to be fair, a lot of that has to do with the recent decline there as well. So that's that one. Let's take it a step further. Let's say, and the word economy is spelt wrong. Somebody's going to notice that. Okay, so let's take a look. Let's say you go, I just want some stocks that I think will recover with the economy as it does start to become more stable and things get back to life. Maybe you're an optimist and you think that's going to happen right now, and this would be something to look at. Twitter, Facebook, PayPal, Uber, eBay, and Google. What I put on there is Goldman Sachs' targets on there since this was their idea. And we said, what's the potential return to get to the target? Now notice something that's starting to pop up here. A loss? The target's 170, but based on where the stock price is currently, if we get to that target, that's a loss, right? Could be that they haven't upgraded their targets yet, or they don't want to. They don't believe it's going to get there. It could also be that the stock has already rallied a little bit, and you need to be a little bit patient on how you wait for this to enter the stock. Same with eBay and same with Google. They've had good runs lately, and so maybe it's just a little bit overpriced. At least that's what Goldman Sachs thinks at the moment, is that the stock is overpriced relative to where they think the fair value is in a 12-month period. So we did the same thing. Max volatility here just to show you over the virus period, February 19th to now. If you were to just buy all these equal weight and build your own portfolio, you've got about a 13% return to get to the target. If you bought them now, you are technically going to take a loss on 2 positions there, so this gets a little bit more difficult. But the volatility remains about the same in terms of what the markets did. This is where it starts to get interesting. Portfolio number 3. Growth over the midterm, right? These are not your day trades, your week trades. These are the trades that, the investments you think, okay, it's going to take some time. I'm willing to hang in there a little bit longer. One thing you may notice off to the far right, these stocks also took quite a bit of a hit. These guys were, think about what happened on the way down. People were selling the stock going, boy, these guys aren't going to recover anytime soon. And so that's why they got hit a little bit harder. You got Lyft, Zillow, CarGurus, Redfin, Stitch Fix, and Lending Club. And as you look at the names, or if you're familiar with the names, you likely understand why it's going to take them a little while to recover. So if we go through and we look at the Goldman Sachs current target versus the return that you would get if it hit the target, you notice that Redfin is going to be a bit of a loss, a little bit of an oversold position there at the moment, also rather beaten down. But now notice something a little different. The potential return for an equal weighted portfolio goes up dramatically, double, right? Okay, so we were taking a bigger risk for a longer time period, or not a bigger risk, but we're taking the risk for a longer time period on stocks that we see over here off to the right are more volatile. You can't see it. So you're saying, okay, but this has to measure out. This is so important. This is what the big portfolio managers, we do the same thing here, that if we're going to invest in something and we expect a larger return and we're going to get, there's more volatility there, then we want that larger return. We don't want to shoot for something with a small little 2% return and all this volatility in the meantime. That would scare our customers. So anyways, portfolio number 3, midterm, focused on obviously things becoming better, the economy getting better and everything, but you're expecting a 32% return with an equal weighted position on all of these here. You're going to experience volatility. Not only has this been more volatile now during the virus, but just letting you know these stocks are more volatile in general. You're sort of starting to ride a bronco, if you will. And then portfolio number 4, these are your long-term picks. These are stocks that they will come back. Goldman thinks they're going to come back. They're going to do well, but it's going to take a while, and in the ultra short term, mostly they think that these are overbought. So you're getting a little bit of a hint as to what the big guys are doing. Look, for example, on Booking Holdings. You understand that's going to take a while for them to come back and people to use that site. But the stock is currently overvalued by about 15% in their eyes. And so what they're telling you is, hey, if you're investing for the long term here and you're thinking about Booking Holdings, Expedia, Eventbrite, Trivago, all these, you may want to hold back in the short term and just kind of put them on a watch list and just keep an eye on these here, because if you bought them all right now and you sold them at Goldman Sachs targets, well, that would result in a loss. Nobody wants that. Again, Goldman Sachs can upgrade their targets. They can choose to do different things here along the way. Just currently, this is where they're at. And so this is the clearest indication, not only for the stock market, but also for this package of stocks there, that Goldman Sachs thinks the stock market in the short term is a little bit overdone. People got a little excited thinking things were going to recover and be all great, maybe a little sooner than expected. And so long-term investments there, you got to be a little bit choosy. I don't want to say time the market, but you're just asking for a better deal before you do dive into this long-term investment. And I have no issues with somebody wanting to do that there. Actually, if you look at that list there, Expedia and TripAdvisor, Goldman Sachs actually says to sell those stocks right now. They have a sell rating on the stock, which makes sense because they've exceeded their price target. They think it's a little bit frothy in the short term, to use a Wall Street term there. So hey, I hope that helps. A different way of looking at things, right? Just trying to pull up some different types of data and share with you opportunities. I want you to do your research. I want you to, for those of you that are out there, you say, I don't need Jazz Wealth, right? I'm still trying to help. So I want you to be able to do your research, feel good about what you're looking up, and now you put your head into little buckets. It's like a bucket strategy where you're saying, okay, I now am defining my time frame, and I'm defining the stocks that go in that time frame, my next time frame, and so on, so that now you've got at least a little bit more focus. Because let's face it, it does get a little bit difficult when you're like, okay, there seems to be a lot of opportunity out there. I'll gobble it all up. Well, you don't have enough money, right? So hopefully this helps you kind of zoom in and, let me know what you think. You think that this is close? Is this way off base? Do you agree, disagree? Did I miss something, or something you'd like me to expand on? We love the geeky data type stuff here, and hope you do too. Enjoy your day.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.